For 2026 just kicking off, there's already a lot going on. So today's video is going to focus on the S&P 500. We'll also look at the Dow Jones Industrial Average and the VIX. So let's kick it off with looking at the bullish patterns. So for the S&P 500, there was a lot of back and forth movement to conclude the year and really for the entire fourth quarter, right? We had that rally really strong at the end of October as many of the biggest mega cap growth names had a good response to earnings. We know that was short-lived, and that led us to the biggest drawdown of 6% that we saw since the April lows. And so it was a lot of debate about whether this was going to turn into a real bearish pattern to roll over and have a much deeper pullback. We know that didn't happen. At the time, we had just achieved one of our last upside targets of 67.45. And so after that time, after the S&P being up over 30%, suggested that we needed more two-way volatility to in fact have the next substantial bullish formation actually have a chance to take shape. Of course, that is exactly what happened over the ensuing number of months. So we got the breakout on December 23rd, had a few good days upside follow through, but then we know that the S&P concluded 2025 with 4 straight losses. That brought it back underneath this breakout zone. At the time, we're telling clients we're still going to give this one the benefit of the doubt, considering that it was very holiday level volume, of course, low volatility, and there was a chance when we start to have people come back from vacation and so forth and so on, that we could see buyer interest return once more. So that's why we kept this one on our pattern grid. So as of right now, still above that breakout zone of 68.80. And so we're showing this in terms of color code just to give us an idea of where risk would be. Of course, right now, still kind of in the neutral zone, meaning that we're still, say, within 1% or so of this breakout area. Beneath it, of course, increases the risk of completely losing this pattern, still giving the benefit of the doubt for now. And of course, as we move into green territory, it just increases the distance between where the S&P is trading and the breakout zone and just increases our conviction that we could eventually have the upside target hit. So still waiting to see how this one plays out, but so far, so good to begin the year. Now, another version we've been looking at and kind of redrew it a few times is this slightly bigger potential cup and handle pattern. And to really make this worthwhile, we have to connect the highs. And so anytime we're connecting highs like this that are making higher highs, it just becomes more difficult for the S&P or whatever we're looking at to actually overtake that zone, right? Because it has to continue to go up, if nothing else, to keep up with the uptrending nature or the upward slope of the line itself. But if in fact it does get above that and stays above it, that's a really impressive breakout, because nothing better than breaking through an uptrending area, because not only will that overtake this line, it would put it way above any other form of resistance along the way. So we'll continue to see how well currently the current live or the most recent bullish pattern breakout is dealt with. And if it is, then we could potentially have 2 bullish pattern breakouts live at the same time. Now, along the way, what has happened? Bearish patterns have continued to fail. We talk about this all the time, and it is probably the most important factor that we look at, even more important than bullish patterns working, because if there's just no real desire to press the issue when there's evidence of the market trying to roll over, it just means, quite simply, the bid remains intact. And once that occurs, we know that oftentimes we have a failed bearish pattern. The move in the opposite direction is that much fiercer, right? You have people covering shorts. You have buyers, of course, going in to buy the dip. And of course, that eventually leads to the formation of the bullish patterns. And of course, you want to see those break out as well. So in effect, we want to see both things happen. And so far, that has been happening again. But, if we get a new all-time high once more and it fails, we'll look at the next iteration to see if that's any different going forward. And so one of the things that changed after Monday was that there were 64 new 52-week highs for the S&P 500, which is not a lot by historical standards, but it is the most we've seen since November 27th, 2024, when there was over 100, as we can tell here. So it got close to that area a few times in July, then actually right before the market rolled over in 2025 had 61. And so if we look at this in isolation, we say, well, just having a lot of new highs doesn't say much, because with this happening at the end of November 2024, we know the market didn't really have much left in the tank, right? Started to see December, of course, start with those 14 straight days of negative breath last year or in 2024, but eventually gave way to fairly bullish patterns and the market rolling over. But again, we care most about how things looked when we first got a strong move or first had a lot of new 52-week highs. So we go back to 2023, S&P was down about 11% here in 3 months. Had the huge rally to start it, and the first time we had over 60 new 52-week highs was here on December 12th, 2023. And that happened at the very beginning stages, for more or less, of this rally that extended all the way. We can pull it all the way to February 2025. Now, not apples to apples, of course, because this has taken so much longer to occur, but it could tell us, with this being led by areas other than large cap growth, that we have some support that we didn't really have before. Now, the breadth has been good all along. We've had, the advanced incline line being new all-time highs once more again over the last few days. We haven't had the ability to see these stocks continue to make new highs, and it is a lagging indicator at times. So the next step, of course, would just be continuing to see this edge higher to the point where we're getting more than 100, as we saw here. Now, even though we want to have the number of new highs continue to move higher, right, and get over 100, I would caution that if and when that does happen, it could lead to some short-term exhaustion if things play out like they did from, again, late 2023 to late 2024. All of these dates indicate the times, or the dates when the S&P had at least 100 stocks make new 52-week highs. And as we can tell, as colored in yellow here, the ensuing trading ranges, or the ensuing price action, at best was digestive, at worst, more of a big pullback, right? And so two things: we want to see this continue to do well, but realize that once that happens, sometimes it leads to buy-side exhaustion, where people are clamoring and so many stocks make new highs that it creates a short-term extended condition. So that would be a good problem to have when it occurs, because we've talked about in the past that we're looking at the short-term work. There's an ebb and flow. This will be part of that going forward. And if you're enjoying this content, check out our free Substack newsletter, Cap Notes, where we put on a lot of premium content, including a much more detailed piece about the most 52-week highs since November 2024 today. We also reviewed a recent chart trade that is up 20% now in less than 4 weeks, and a lot more. Again, it's capnotes.substack.com. Check it out. Look forward to seeing you there. So let's move on to the go, no-go work. And it continues to be in go mode. And again, we talked about this over the last few weeks, how there was a few whipsaws in play as the market was rolling over. We talked about how this looked like a bearish pattern. When that was occurring and this flipped to no-go, there was a concern, because that could be the beginning stages of a market rolling over. Of course, that did not happen. And so, as is typically the case, as the market then tries to find its way once more, you're going to have more whipsaws, which happened again as the end of the year was upon us in December. But along the way, what do we have? Higher lows, and now the trend is up once more, just as the S&P is trying to break out from those two bullish patterns and making new highs, which of course is something we want to see. And from a weekly perspective, nothing really changed. The only time we saw any change at all was when the very bullish bars just went down to bullish here, right? So strong uptrend to just uptrend, green bars for 2 weeks, and they continued higher. Again, we're getting close to 30 straight weeks of being in a weekly go mode. We talked about this many times. This is very similar to strong rallies you've seen over the years, where it takes some time for the weekly trend to trigger to go. But once it has, and it's taken the S&P out of that high volatility period into more consistent uptrend, we see it here. And again, it makes sense to stick with this trend until that changes, right? More of an intermediate to long-term point of view. So let's turn to the Dow now, which, the S&P was down very marginally in December, but that officially ended its monthly winning streak at 7. But the Dow Jones Industrial Average was up 8 straight months. And Sentiment Trader put out this a few days ago, looking at what the S&P 500 did after the Dow was up 8 straight months. And as we can tell here, the S&P 500 was up 8 of the next 9 times 12 months later, which is highlighted here in blue. As we can tell down here, up 100% of the time, 2, 3, and 6 months later. Just because the S&P couldn't extend its winning streak, the Dow Jones did, and that just tells us what? There's been relative strength in areas outside of mega cap growth, which of course has a much bigger influence in the S&P 500 itself. So the question is, can the Dow continue to outperform the S&P 500, right? This is what it looks like just over the last few months. You can hardly see any sort of change because it's really been making lower highs and lower lows all the way since the beginning of 2023. But there are a few instances going back to the last 15 years where this did last longer than just a few months or so. That occurred from the middle of 2016 to the beginning of 2018, and much more evident from late 2021 to the beginning of 2023. And so could it happen again? Sure. But doesn't necessarily mean, if it does, that the market overall will continue to go higher. Because as we can tell, again, this happened in all of 2022 because many of the larger cap growth names got hit hard. And when they get hit hard, what does it do? It takes the major indices down with them. So there will be some chances to have relative outperformance no matter what type of market that we're in. But keeping track of this ratio can give us an idea of what phase we're actually trading within as things go along. And so another study that was very interesting, which was shared by the Market Stats, was that in the middle or toward the end of December, the VIX undercut 14 for the first time in over a year. And obviously, when that happens, the first time in more than 6 months, there's pretty strong results going forward 6 to 9 months and 1 year out. And here's blown up what it looks like over the past few times it occurred since 1990, which of course is when the VIX began. We have a 100% win rate, an average move of 12.6% over the next year. As you can tell, when it occurred in June 2023, it was up a lot, almost 25%. So again, just another indication that strength begets strength, no matter if we're looking at the VIX, another way of measuring volatility, or the S&P 500 itself. So we all know about seasonality, but I thought this particular way of looking at it really gave a very good indication of what to expect. And this was shared by Blue Kurtic Market Insights, does great work, shares a lot of it on Twitter. So what this shows is a few things, right? Obviously the average gain, but also looking at the average max loss, which is measured from the previous year's final print to low from the current year, and also the average max drawdown, so the biggest drawdown intra-year as well. So not surprisingly, but still interesting, is that these both are much less than what we see in an average year, and also when you have a negative January. So negative January produces an average move of negative 1.75%, but the average max loss of almost negative 17%, the average max drawdown of over 18%, or nearly a bear market, 20%. So there is something to this, even though it's seasonality based, but it sometimes does lead to a very different kind of year based on what January does. And so really, regardless of what happens, we do have to expect some drawdowns. And this was shared by Charlie Bolello of Creative Planning, as we know, the czar of sharing free content on the internet. And so what this shows us is all of the years going back to 1928 with the max intraday drawdowns versus the end of the year total return. So it includes dividends, right? And so all on the way, you can see that the market was up 15 out of the last 17 years. And of those 17 years, there were drawdowns greater than 10% 11 times. And so even if the market ends up higher for the year, we shouldn't anticipate a straight line higher. We just had a 16% gain for the year, 2025. Sounds great. Sounds like an easygoing uptrend. As you know, that wasn't the case. So along the way, we're going to look at the market the same way. Look at all of these stats, but in the end, it's all about the pattern work, right? Digestive phases that can resolve to the upside, uptrend, that just the phases that get resolved to the downside could be some trouble because we haven't seen that play out in a long time other than the tariff tantrum from last year. That's what we have for today. Don't forget to check out some other videos which we have right here.